The ASX 200 rallied for a second straight day on Wednesday, and the Reserve Bank of Australia hiked rates in the same week. That contradiction is the story. Oil above $100 a barrel pushed headline PCE inflation to 3.5% in the United States and forced the RBA to lift its cash rate to 4.35%, the highest level since November 2011. The RBA said explicitly that Middle East conflict had added sharply to fuel and commodity prices, which were already feeding through into consumer goods. Inflation was too high and too broad-based before the Iran shock arrived. The shock did not create the problem, it accelerated it. The transmission to Australian households is direct. Mortgage repayments rise immediately after each RBA move, and the cash rate increase compounds earlier hikes still working through variable rate loans. A quarter of Australian households already reported cash flow problems in 2025, according to the ABS, before the oil surge. Super Retail Group, the parent of Supercheap Auto and Rebel, flagged the pressure explicitly. Sales momentum across all four brands was hit hardest over the Easter trading period by rising fuel prices, interest rate stress, and fuel availability concerns in regional areas. The stock fell more than 10% on the update. BCF, its outdoor brand, suffered the most. Outdoor recreation trips fell as fuel costs made regional travel prohibitive. The RBA's own forecasts now show trimmed mean inflation running higher than the path projected in February, before the Iran conflict. GSFM's Stephen Miller warned that another rate hike later this year remains possible. Australian productivity has fallen 4% since late 2021, even as U.S. productivity rose nearly 7% over the same period. A central bank tightening into a productivity deficit is a fragile combination. The consumer side of the ASX is not priced for a second hike.
The rate pain landed unevenly because the Iran shock also split the ASX down the middle by sector. Energy stocks fell sharply as U.S.-Iran peace talks advanced. A one-page memorandum from the White House aimed at gradually reopening the Strait of Hormuz sent Brent crude down more than 7% in a single session, briefly breaking below $100 a barrel. Oil names that had been inflated by war premium gave back gains fast. Woodside and Santos bore the brunt. But the same peace signal that crushed oil stocks ignited miners. BHP jumped more than 3.25% and is now within 2% of all-time highs after rallying more than 6% across two sessions. The mechanism is indirect but clear. Falling oil prices reduce input cost pressure on mining operations while also signaling reduced macro tail risk, pulling capital back into risk assets. Copper surged to around US $6.20 per pound. Iron ore rose. Uranium names continued their own separate rally driven by U.S. nuclear demand. South 32, Rio Tinto, Fortescue, and Paladin Energy all moved higher. The counter-signal worth watching. BHP's proximity to all-time highs assumes peace talks succeed and oil remains below 100. If the Strait of Hormuz reopening stalls, Trump said a deal was close but also warned bombing could restart. The war premium returns to oil, input costs for miners rise, and the commodity rally reverses partially. BHP at near-record levels with that condition attached is a holding, not a conviction buy.
Under the commodity split, a longer structural shift is accelerating, and it terminates directly in ASX lithium stocks. Lithium carbonate is up 58% year-to-date in 2026, the strongest performance of any commodity this year. That compares to 8.9% for gold, 8% for copper, and 3.5% for iron ore. The spodumene price has risen from below US $600 per ton in mid-2025 to US $27.52 today. The trigger for the turn was supply rebalancing after 2 years of mine closures, but the acceleration comes from the Iran oil shock. Analysts at Trading Economics noted that the surge in crude and product prices since March directly supported the case for electric vehicles in major economies, which require battery-grade lithium at scale. China simultaneously announced it would double national EV charging capacity to 180 gigawatts by 2027. That demand signal is now reaching corporate action. Chinese battery material giant Zhejiang Huayu Cobalt launched a $292 million takeover of Atlantic Lithium, valuing its Iowaya project in Ghana, which would be that country's first lithium mine, at 35.4 cents per share. Atlantic Lithium's board unanimously recommended the deal. Its largest shareholder, Assor, with 26.4% of the company, indicated it would vote in favor. This is not speculative demand. It is a strategic buyer locking in hard rock lithium supply ahead of anticipated EV production growth. ASX lithium names followed.
IGO rose 4.3%, Mineral Resources gained 2.1%, and is now up 29% year-to-date. PLS Group hit a new record price. The forward condition that determines whether this holds is affordability of the oil shock. If Hormuz reopens fully and oil normalizes toward pre-war levels, the EV urgency signal fades at the margin. The Lithium Re-rate would slow without reversing, because structural battery demand from data centers and Chinese infrastructure continues regardless of oil prices. But if peace talks collapse and oil stays above $100 through northern summer, Morgan Stanley projects U.S. gasoline inventories will fall below 200 million barrels by late August. The EV adoption pressure accelerates, and the lithium trade deepens. Watch Brent crude against the $100 level. That threshold is the hinge for this entire causal chain. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.